Rivian just shocked the market. In a single week, the stock jumped roughly 30%, and on the surface, it looks like something big must have changed. After all, Rivian just reported something it has never reported before: a profit, or at least something that looks like one. In Q3 of 2025, Rivian announced a consolidated gross profit of $24 million. That's a milestone. It means that, on paper, Rivian is finally making money selling its vehicles once you subtract the cost of building them. For a company that has been burning cash for years, that sounds like a turning point. It sounds like progress. It sounds bullish. But here's the problem. That headline profit is a false flag, because while Rivian posted a gross profit, the company's overall net loss actually widened. In Q3 alone, Rivian lost about $1.17 billion. That loss is driven by massive ongoing spending on R&D, vehicle development for the upcoming R2, and the cost of scaling operations. So yes, gross profit technically arrived, but the business as a whole is still bleeding cash at an extraordinary rate. So the obvious question is this: why did the stock surge 30%? Why is Rivian suddenly worth almost a third more than it was just a month ago? That's a genuinely good question, and if you think you already know the answer, it's worth questioning whether that answer actually holds up when you look at the details. Let's look at what actually happened. Just days earlier, Rivian's stock was sitting around $12.50. Within about 5 days, it climbed to roughly $16. That kind of move doesn't usually happen without major news. You'd expect a breakthrough product, a massive sales increase, or at least a dramatic improvement in fundamentals. But that's not what drove it. The biggest piece of news wasn't about sales, margins, or demand. It was about compensation. Rivian's board approved a new pay package for founder and CEO RJ Scaringe, a package that could be worth as much as $4.6 billion. Let that sink in for a moment. Rivian has never posted an annual profit. It is still losing over $1 billion per quarter, and yet the CEO could potentially walk away with one of the largest compensation packages in automotive history. And strangely enough, the market seemed to like it. The board framed this new package as an incentive plan designed to keep the CEO focused and committed over the next decade. That framing alone assumes Rivian will still exist in anything resembling its current form 10 years from now, which is far from guaranteed. If everything in this revised package comes to fruition, it could indeed become one of the biggest CEO payouts the industry has ever seen. And yet, Rivian is not a high-volume automaker. Despite being a recognizable name in the US, it sells relatively few vehicles. Yes, Rivian's financials have improved on the surface. Q3 showed higher revenue, higher gross profit, and slightly higher deliveries, but the scale is still extremely small. In Q3, Rivian delivered about 13,200 vehicles worldwide. That works out to roughly 4,400 vehicles per month, globally. That's not mass production. That's closer to niche manufacturer territory, Ferrari-level volumes, not Tesla-level volumes. And this is happening at a time when EV incentives in the US are fading, not expanding. Without strong international exposure, Rivian remains heavily dependent on a US market that is growing far more slowly than the rest of the world. To put this into context, global EV sales over the first 10 months of the year grew about 48%. Europe grew around 34%. China grew roughly 23%. The US, meanwhile, barely moved the needle, with growth of around 4%. That matters, because Rivian sells almost exclusively in the US. It doesn't have meaningful insulation from US policy shifts, incentives, or demand slowdowns. Investors cheering this rally may not be fully appreciating that risk. Now let's look at the numbers more closely. In Q1, Rivian delivered 8,640 vehicles. In Q2, that rose to 10,661. In Q3, deliveries reached about 13,200. Revenue for Q3 came in at $1.56 billion, up 78% year-over-year. Of that, $1.14 billion came from automotive revenue, while software and services generated $46 million, a massive year-over-year increase percentage-wise, but still small in absolute terms. Gross profit totaled $24 million. Automotive gross profit was still negative, while software and services were solidly positive. The overall picture is improvement, yes, but improvement from a very low base. Now look at the losses. In Q2, Rivian lost about $1.1 billion. In Q3, it lost roughly $1.17 billion. That's about $2.3 billion lost in just 6 months. And despite that, the stock is up 30%. Why? Because investors appear to be reacting to confidence, specifically confidence implied by a CEO pay package that lowers performance targets significantly compared to the previous plan. The revised milestones for stock price range from $40 to $140 per share over the next decade, down dramatically from the prior targets that went as high as $295 per share. In other words, the bar was lowered a lot, and the market interpreted that as realism, optimism, or alignment. Take your pick. The CEO's base salary was doubled to $2 million, and the new plan grants options to purchase up to 36.5 million shares at an exercise price of $15. If all milestones are hit, the CEO could earn up to $4.6 billion, while shareholders would theoretically gain around $15 billion in value. On paper, it sounds aligned. In reality, it assumes Rivian can survive long enough to even attempt hitting those milestones. To me, this entire move feels like hysteria. It doesn't line up with the fundamentals. Rivian is burning cash at a rate that simply isn't sustainable for another decade. You cannot lose over $1 billion every quarter indefinitely and expect to survive without massive dilution, restructuring, or acquisition. If you've benefited from this rally, this is exactly the kind of moment where emotions take over. And emotions are the enemy of good investing. I want to be clear about something. I love Rivian vehicles, I genuinely do. The trucks look great. The design is excellent. I'd love to own one. My dad loves them too. We talk about how cool it would be to have one, how great they look, how unfortunate it is that they aren't widely available in places like Australia. But liking a product is not an investment thesis. Money and emotion do not mix. They never have. And that's precisely why most investors underperform. They fall in love with stories instead of numbers. Rivian today is selling roughly 1/10 the monthly volume of companies that are still struggling to reach profitability themselves. Other EV makers selling 40 or 50,000 vehicles per month are openly worried about survival. Rivian is selling about 4,500. That gap matters. Personally, I think the odds of Rivian surviving as an independent company 10 years from now are extremely low. It may be acquired, it may be absorbed, it may exist in some other form, but the idea that it continues burning cash at this rate and simply grows into these valuations doesn't align with reality. If you disagree, that's fine, but understand that disagreement is likely emotional, not factual. The math simply doesn't support the optimism. And that's why, despite the 30% rally, this is not a stock I would touch.